US government debt is starting to become a problem, and a problem for the US is also a problem for the rest of the world. In this video, I'll show you how much debt the US government actually has, explain why this matters, and also discuss how investors can protect their portfolios if the problem escalates. This video is sponsored by Freetrade, the commission-free investment platform that is revolutionizing the world of investing in the UK market. A good place to start is how much US debt is actually out there. Now, if we're going to compare countries, the natural way to do that is to look at the amount of outstanding government debt, that's a dollar amount, say, and we divide it by the gross domestic product of that country. And that's simply because the amount of debt which a certain economy can sustain is in proportion to the size of the economy. Now, there's a nice interactive map which you can find on the IMF's website, and here you can see countries sorted by their debt to GDP ratio. Now, Japan's way out there. Its debt to GDP ratio is over 260%, and you can see that the United States is now in 5th place at around 120% debt to GDP. Now, you might see another debt to GDP ratio quoted later on, which is roughly 100% of debt to GDP for the US, and that corrects for the fact that some of the debt is held by government entities. So it's money that the US government owes to itself. Now, US GDP in 2023 was about $27 trillion, so the amount of debt is roughly equal to that. So that's the stock of debt. It's the amount of debt which is currently outstanding. Of course, that's a dynamic picture because new bonds are issued all the time in order to fund the government, and some bonds mature each year. So another way to think about debt is how quickly it's increasing. And while the debt to GDP ratio is higher than it's been historically in the US, here you can see a graph going all the way back to the Second World War, and debt to GDP is roughly where we were then. But what has people worried at the moment, and this is a projection from the Congressional Budget Office. This is a non-political governmental organization whose job it is to look at sustainability of US debt. And if this projection is correct, it suggests that the debt to GDP ratio is going to carry on increasing for the foreseeable future. So it's not just the fact that the stock is fairly high now. If it stayed at 100%, I don't think people would be that worried. It's the fact that it doesn't seem to be sustainable. That's what really has people worried at the moment. Now, why is it that the US debt to GDP ratio is growing? What numbers would we look at to determine whether that's the case and whether it's sustainable? Well, there's a very simple equation which determines that rate of growth. The increase in debt is driven primarily by two things. The first factor is the amount of interest which has to be paid by the US government every year to service its outstanding stock of debt. That's just the average rate of interest for its US treasuries multiplied by the amount of those treasuries outstanding. The other factor is under the control of the government, and that's the difference between the rate of revenue which the government receives, usually in the form of taxes, minus the amount of spending which the government carries out. And that difference, the difference between spending and income for the government, is called the primary balance. If the primary balance is negative, that's called a deficit. And the US deficit at the moment is quite large, certainly by historic standards, and that's one of the factors which is driving the debt to GDP ratio upwards. The other factor is that interest rates are now higher, so that debt servicing cost is also higher, and both of these factors are increasing the debt to GDP ratio. So let's start off by digging into that primary balance. That's the difference between spending and income for the US government. US government spending can also be split up into two components, and that's mandatory spending. This is also called entitlement spending, and this is the government spending on certain programs which are required by law. That's not subject to the annual the annual appropriations process, and it occurs automatically based on eligibility rules which are set by Congress. In contrast, discretionary spending is the portion of the budget which is decided by Congress through this annual appropriations process. So mandatory spending is more difficult to change. It can be changed, but it isn't easy to do so. Discretionary spending is easier to change. So in the top panel here, you can see the total outlays for the US government in 2023, and it's expressed as a kind of pie chart as a proportion of GDP. So the total outlays, the total cost of running the US government in 2023 was $6.1 trillion. 3.8 trillion of that was mandatory, 1.7 trillion of it was discretionary, and you can see the net interest cost there was around $660 billion. Now notice the expensive stuff here in particular is medical expenses. So that's Medicare and Medicaid, but also things like income security programs. If we look at the total revenues of the US government in 2023, that was $4.4 trillion. So the deficit is the difference between the two of those. And 6.1 minus 4.4 gives you 1.7 trillion deficit. Now, if we express that as a percentage of GDP and compare it with the past, you can see that it's 6.3%. And if we compare that with the average over the last 50 years, you can see that it's pretty high. That average was only 3.7% of GDP. And if you're wondering about the other component which has pushed up the debt to GDP ratio, which is the cost of servicing US debt, you can also see here in this infographic from the CBO that debt servicing cost has increased 87% over the period from 2021 to 2023. So you're probably wondering, well, why doesn't the government just spend less if it knows there's a big deficit? Why does the government continue to spend so much and continue to increase its debt to GDP ratio? Well, I think one of the reasons is the mandatory spending components, which are very difficult to cut. If we compare the mandatory outlays in 2003 with the ones in 2023, that's just 2 decades apart, look at how much Medicare and Medicaid have increased over that period of time as a percentage of GDP. Also, those income security programs have become more costly. And of course, there's an underlying reason behind this increased cost of medical programs and income security programs, which is that the US society as a whole is aging. So demographics is behind this shift. Older people tend to be more expensive to look after and require more medical assistance. So bearing that in mind, now let's dig into those CBO projections for the next 30 years. So this takes us from 2024 to 2054. The fundamental problem is that revenue as a percentage of GDP really doesn't increase much over that projected period. It only increases by 1.3 percentage points, whereas outlays increase more by 4.2 percentage points due to those factors that we discussed, primarily due to an aging US society. That means that the US is going to have to run a deficit for an extended period of time, and of course that increases the debt to GDP ratio from just under 100% currently all the way up to 166% by 2054. Today's video is sponsored by Freetrade. Commission eating up your investments? Look no further than Freetrade for your solution. Invest commission free for over 6,200 UK, European and US stocks and ETFs. Today, Freetrade is also offering a free share worth between £10 and £100 exclusively for PensionCraft's audience. Ready to claim your free share? Head over to freetrade.io/PensionCraft today. You can also find the link in the description box below. Simply download the app, fund your account with at least £50 and get a free share. Looking for more? Freetrade also offers tax-efficient investing through a stocks and shares ISA and a self-invested personal pension. Prefer low-risk investments? They also offer you the only direct access to UK Treasury bills alongside an assortment of low-risk cash ETFs. With their Plus plan, you can earn 5% AER on up to £3,000 of uninvested cash while you decide where to invest. Perfect for all investment appetites. Never heard of Freetrade? They've been recognised as the best online trading platform at the British Bank Awards for 6 years in a row, as well as being recognised by Boring Money for share traders and low-cost ISAs more than 50k, to name a few of their accolades. Don't forget, visit freetrade.io/PensionCraft today to get your free share. Well, you might be thinking, why does this matter anyway? The US debt to GDP ratio has been high for a while, and Japan's all the way out at well over 250%. Well, here's Philip Schwagel, director of the Congressional Budget Office, which gave us those forecasts, and he's clearly worried. Schwegel said that the danger, of course, is what the UK faced with former Prime Minister Truss, where policymakers try to take an action and then there's a market reaction to that action. And if you cast your mind back, the reason for that reaction was that the UK government suggested a series of unfunded tax cuts, and at the same time, they were increasing spending in order to stimulate growth. And they reversed a planned corporation tax cut and cut the basic rate of income tax. And they abolished the top rate of income tax for the highest earners. At the same time, they were going to increase spending on things like an energy price guarantee for households and businesses. Now, markets can absorb increased amounts of debt as long as you signal it correctly. However, in this case, the UK didn't signal it correctly, the government didn't, and markets balked. Gilt yields spiked, sterling faced a run on the currency, and the Bank of England had to step in and start buying huge amounts of UK gilts in order to stop the free fall of UK debt markets. Now, you're probably thinking, okay, that happened to the UK. It's a relatively small economy compared to the US. Surely it couldn't happen in the biggest economy in the world. So that's why I think it's shocking that Philip Schwegel says that it is a possibility. Now, recently, Fitch downgraded US debt, and this has happened a couple of times in the past. People usually just laugh it off. Oh, don't be ridiculous. You shouldn't downgrade US debt. It's still absolutely fine. But I think it pays to actually dig into what Fitch said when they issued this downgrade. Perhaps the most shocking statement that Fitch comes up with in its justification was about governance, the poor governance of the United States by Congress. They cite the repeated debt limit political standoffs in the US. As many of you know, it's often the case that they leave it to the wire in order to raise the US debt ceiling. I think it's the only country in the world which does this. It has a cap on the amount of outstanding debt, and it has to raise it by law. And it usually turns into a huge fight between Democrats and Republicans to determine whether they're willing to allow that to happen. And according to Fitch, that kind of last-minute resolution that we always get in the end has eroded confidence in the US's fiscal management. It might be that one time it doesn't happen in time and there will be a technical default on US debt. Another point is that there is no medium-term plan in order to determine how US spending can be cut. Also, the budgeting process is very complex in the United States. The pattern that we've tended to see in recent history has been one of corporate tax cuts, followed by new spending initiatives. Trump, for example, was famous for his tax cuts in 2017, and Joe Biden has done lots of fiscal stimulus via increased spending. Fitch also expects weak growth in the United States, and weak growth means weak tax revenue growth. Also, they're saying that state and local governments are expected to run an overall deficit. Also, the cuts that we've seen in non-defense discretionary spending have only amounted to about 15% of the total spending. And they don't think that's going to be sufficient in order to reduce the deficit significantly. And of course, we've got an election coming up in November 2024, and it's unlikely that there are going to be spending cuts announced before that happens. They're never politically popular. So as a consequence of all of these shocks we've seen in the recent past, and also the inability to cut spending, the debt to GDP ratio is currently 2.5 times that of other AAA countries. So for a AAA sovereign, you'd expect roughly a 40% debt to GDP ratio. Even a AA country, the median is about 45% debt to GDP. So to a certain extent, the US is given a little bit of leeway because it's such a powerful economy, but not that much leeway. And if there are future economic shocks, which there may be, then the US isn't in a great position to spend in order to soften the economic blow. So just like the CBO, Fitch is worried about spending on Medicare, Medicaid, and Social Security programs. And what they expect is that the tax cuts, which were announced in 2017 by Trump, which are assumed to expire in 2025, probably won't expire. There'll be political pressure to make them permanent, and that'll further erode the US's debt situation. And that's because it's going to increase the deficit. So you might be thinking, well, surely it's a good thing that the government is spending money in order to stimulate their economy. This may be one of the reasons why the US is so much further ahead than other countries, in developed markets at least, in terms of its GDP growth following the pandemic. And I think that's true. But one problem with increased government spending is something called crowding out. The problem here is that if the government spends a lot, it has to borrow to do so. It's not through higher taxes. And if that's the case, then the cost of borrowing usually increases because lots of issuance of new debt tends to push up yields. That means that real interest rates increase, and it also increases the cost of borrowing for companies. So if the cost of capital is higher for those companies, they're less likely to do their own investing. So public investment crowds out private investment, or so the theory goes. And there's a nice quote from Jason Furman. He used to be the chair of the Council of Economic Advisors. This is to the Obama administration, and he's currently a professor of economics at Harvard. And in a recent interview on a podcast in the FT, he said there's been a huge increase in investment in manufacturing structures in the United States, and that's because investment has been subsidized. When you subsidize something, you get more of it, but interest rates have gone up and the cost of construction has gone up. So you look at every other type of structure, transportation, warehouses, etc., they're all down and below where they were at the end of 2019. And we're in a situation right now where the government, by subsidizing some things, is getting more of those things, which is good, but at the expense of higher interest rates, and that's at the expense of other things. So his point is that this crowding out effect has starved investment in things in which the government hasn't invested. So programs like the Inflation Reduction Act have created a greener economy in future, hopefully. But Furman's point is that it doesn't mean they're going to have a larger economy. Now you're probably thinking this is a US problem, why should I care? I don't live in the United States, if you don't. However, I think that's a mistake. And the reason for that is that the US is such a large economy and such a large market. If we look at 10-year yields in the US, also in Germany and in the UK, notice how if we look over a very long period of time, yields tend to track each other up and down. One reason for that is, to some extent, debt from Germany, the UK, the US are kind of equivalent. They're all very safe. And the typical investors in each of those markets has a choice. If US yields are much higher than they are in the UK, well, pension funds in the UK will probably buy US treasuries. They may hedge them, currency hedge them, but they will buy them. So if US yields go up, then it tends to push up yields in other countries as well. Now, because the US is such a large debt market, such a liquid market, it tends to be the dog which wags the tail of other bond markets around the world. And there was an interesting recent report from Barclays. Every year they publish their equity gilt study. And in the one in 2024, one of their points is about this exported monetary policy from the United States. And what they tried to estimate was if the US increases its 10-year yield on its treasuries by, say, 1%, what effect would that have on other countries? And as you can see here in the case of the UK, about 85% of that yield increase will be passed on to us, whether it's appropriate for us or not. And it probably isn't appropriate because our economy is weaker than that of the US. So while tightening of policy for the US economy might make sense, it probably doesn't make sense for the UK, but it will weaken growth here nonetheless, even though we can hardly afford to do so. And that's not just true of the US, it's true of the rest of the world. So here, for example, you can see there's a bigger effect on Canadian yields, Australian yields, and to a lesser extent, European yields. So if there is a crisis in the US market, you bet it's going to affect the UK and the rest of the world. It really depends on the severity of the sell-off in US Treasuries. If it's just a gradual deterioration of the debt to GDP ratio, then I think markets could probably absorb it. But if we do get a kind of Truss Kwarteng type shock, where markets suddenly reject a big slew of issuance, a treasury tsunami as Barclays have called it, then it could have huge implications for not just the debt market, but for equity markets too. If yields spike upwards, remember that US Treasuries are seen as the safest asset on the planet. And if you pull that rug on US Treasuries, then you pull the rug on every single asset in the world, which would then reprice downwards. Higher yield means lower future discounted cash flows. So make no mistake, if the US has a problem with its debt market, a severe problem, then it's everybody's problem. If that's the case, and it really does spiral out of control, then what can people do to protect their investments? Well, if things get really bad, and I mean really bad, then gold is usually quite a good hedge. That's because it's seen as a kind of safe haven investment, particularly as it's not a country-dependent hedge. Gold isn't tied to any particular currency or government. It's seen as safe across the world. Another thing that would make sense, I think, is cash in your local currency. Assuming, of course, that the repercussions aren't totally catastrophic and the entire banking system doesn't collapse. That in itself is very unlikely. If you did want to stay exposed to the stock market, it would reprice downwards. Different sectors, different factors would be differentially affected. I think the focus clearly should be on quality stocks, but also value stocks, things which pay a high dividend and which aren't overpriced. And something which is almost certainly going to suffer a lot are growth stocks. So for example, the Nasdaq, which has done so incredibly well for so long, I think would be very particularly heavily hit by this kind of problem. So what I'm not trying to do here is to scare you. This is not something which I think is likely to happen. It's not a central case, but this is a kind of tail risk which we should be aware of. What we're gradually seeing is the deterioration of the debt to GDP ratio in the US. So it's a problem that everyone can see coming. The really scary stuff happens if there's a rapid dislocation in yields. And that kind of accident is now more likely, I think, given where we are at the moment. Now don't forget our offer from Freetrade, the sponsor of today's video, to claim a free share worth between £10 and £100. Terms and conditions apply. This is an offer exclusively for PensionCraft's audience, remember. Head over to freetrade.io/PensionCraft and you can also find that link in the description below. And, as always, thank you for listening.